Hi, everyone. We want to welcome you to today's program, The Impact of COVID-19 on Clients' Life Insurance and the Secure Act, sponsored by the Senior Lawyer Section and the Committee on Continuing Legal Education of the New York State Bar Association. Today's program will run from 12 p.m. to 1 p.m. Please note that you must remain on the line for the duration of the program to receive MCLE credit for your participation. Participants are welcome to pose questions using the Q&A box in the Zoom portal, and we will answer the questions at the end of each speaker's presentation. At the conclusion of today's program, please be sure to return to your My Learning dashboard and enter in the verification code to receive your MCLE certificate. A PDF of the verification form and course materials are also available in your My Learning dashboard. Instructions on how to access your My Learning dashboard are available in the greetings email you received earlier today. Our speakers today are Jay Sherrill and Henry Montag. Henry, the floor is yours.
Thank you. Good afternoon. My name is Henry Montag, and I'd like to thank everyone on the call for joining us. I'd also like to thank Carol Burns, Steve Gallagher, Dan, and Tiffany for arranging and for setting everything up this afternoon. So this afternoon, we're going to be talking about the Secure Act, a law that basically affects every American's retirement savings and calls for everyone to adjust and revise their plans, particularly those that intended to use the IRA, their IRAs, as wealth transfer to the next generation, as they'll now generate significant new tax liabilities for their beneficiaries. Now, life insurance has become the generally accepted best practice to relieve that future tax liability for their beneficiaries. But what effects does the COVID pandemic have on various types of insurances? And what's the best strategy to offset the additional tax liability? Well, first, Jay will discuss and give us some of the basic tenets of the Secure Act and provide us with some interesting legal useful strategies. That'll go on for about 25 minutes. Then I'll come back and discuss the pandemic's effect on the various types of life insurances, including the good, the bad, and the ugly points, as well as some issues and strategies that you and your clients will be glad that you're aware of. And that'll go on for about 20-25 minutes. Lastly, we'll conclude with 10 minutes at least of questions from the both of us. So please don't forget to download our handout materials. Now it's my pleasure to introduce Jay Sherrill, an attorney that I've heard speak and is extremely knowledgeable regarding this new law. Jay, the floor is yours.
Thank you. Thank you, Henry. Thank you to the New York State Bar Association for inviting me today. Thank you, Henry, for arranging this. And also, thank you to the Senior Lawyer Section. I'm honored to be here today, virtually joining you from down here on Long Island, although I'm sure we're coming in from all over the state. So it's been a little bit surreal not having to hop in the car or the train to have to get to a speaking engagement and be able to just walk into to the office here and sit in front of a camera. So I'm glad to be able to do that to you today. Lots of opportunities presenting themselves in the most places you wouldn't even think of, right? So that's the goal of today's webinar, at least for my part as well, is to talk about some unique opportunities that you might have with clients, maybe even yourselves, with the Secure Act. Now, just to talk a little bit about the Secure Act. The Secure Act came out last year. We saw it signed into law December 2018, right around holidays. It came in 2020. I don't think it's really many people at this point right now are kind of mode going through everything with COVID right now in terms of their businesses, their families, but there's some really unique opportunities here within the Secure Act that we can help our clients. As we mentioned, this affects most individuals who have traditional retirement plans. The Secure Act stands for setting every community up for retirement enhancement. This is one of the largest changes that we've seen to the area of traditional retirement plans in a very long time. And I'm going to go through what I had told Henry and promised him that I would do today, is to go through in my part of the presentation today some of the most significant provisions of the Secure Act that affect both either yourselves or your clients. And then we're really going to focus in on one particular provision and how life insurance can change, be a piece that we can use to help plan around the significant change in that area. Then I discussed with Henry, and I promised him that I would go through a scenario, just to put it down. So we're talking about the law, we'll talk about the basics of this strategy, and I'll give you an illustrative strategy and how that can help with a John client and go through those numbers. And then at the end, I'll conclude my piece and pass it over to Henry to talk about the different types of life insurance policies and how they can be used in conjunction with this strategy. So there's a number of different provisions in the Secure Act. The first one I wanted to bring to your attention and speak about today is the increase in the required beginning date for required minimum distributions. And what that is again, if we talk about the basics of a retirement policy, what they are really a tax deferment vehicle. Either I have, before I pay taxes on my income, contributed money to an IRA, or I've taken money out and then I've paid with after-tax dollars but gotten a tax benefit on my tax return. This account is tax deferred. So for a large part of my life, right, I'm going to contribute to this account. It may be invested. Money will start to grow in this account. I'm not paying taxes on that now. But at some point, the IRS says, well, the bill is going to come due. You can't defer these taxes forever. It used to be that you would have to start taking a distribution at the age of 70 and a half. The way that they used this was to say, look, we're going to defer out these taxes, but at 70 and a half, you're going to have to start taking distributions. You don't need to take out all of the account all at once. Obviously, if you need it or a client needs it, they can do that. But we're going to have a minimum distribution. And the way that the minimum distribution is essentially set up is by taking the person's life expectancy and dividing the account value by that life expectancy to come up with equal payments that the person has to take out every year, okay? Now, obviously from a client perspective, the longer we can delay making distributions from the account, assuming we don't need the funds for our cash flow, the longer that we can delay making those payments, the better. Why? Because that means the longer I can delay that ultimate tax bill. And a large part of this strategy that we're going to talk about is the income tax, the tax strategy here to minimize tax liabilities. So this was a big provision, changing that required beginning date from 70 and a half to now 72. Another big change was the repeal of the maximum age for contributions to traditional IRAs. Under the old laws that stood before the Secure Act, the last age and the oldest you could be to contribute additional funds to the IRA was at 70 and a half. And now there is no maximum age. A person can continue to contribute to a traditional IRA if that makes sense for them. In the scenario we're talking about today that we're going to talk about is really going to deal with getting money out of an IRA. So we're not going to focus in on actually any of the provisions on this screen. Just want to give you a comprehensive overview of the many different provisions. The third provision that we'll talk about, is a big piece of the Secure Act, is the allowance of penalty-free withdrawals from the IRA of up to $5,000 by each parent in the year of birth or adoption of a child. So what happens is with the IRA, once we've claimed this tax benefit, I can't start taking out withdrawals just because I want. If I wanted to buy another house, for example, I could not just start taking money out of the IRA without having a penalty. Okay, the way it works is every time you take a distribution of the account, like we talked about with the RMDs, you're paying income taxes. It's taxable income. But if you were under the age of 59 and a half, you would pay an additional 10% tax, okay, as a penalty for an early distribution. Now that's still there, but where they're allowing an exemption for if I had a child, I could take $5,000 out. My wife could take $5,000 out if we had a child and we took it out that year. Now that would not be tax-free. I would still owe taxes on that, on my tax bracket, right? In my tax return, it would show up as ordinary income. But what I would be free from would be this penalty, okay? This 10% additional tax that would be tacked on top of that. The largest, by far, the most sweeping change though that's occurred as part of the Secure Act is the elimination of this stretch, okay? For what that is let's talk about how inherited IRAs work. This deals only really when we're talking about inherited IRAs. So remember we talked about here in the previous slide, we said the person needs to take out a required minimum distribution. But what happens when that person passes away before they have exhausted the amount in the plan. Well, what happens is in the old law, they would have been able to leave that to any number of beneficiaries they chose, and that beneficiary would be able to stretch that payment out over their lifetime. And we'll talk about the comparisons between the two laws in the next couple of slides and an illustration of just how sweeping that change is. But under the Secure Act, any non-spouse beneficiary that inherits an IRA, okay, must withdraw the entire account balance within 10 years. Now, why is that significant? The same provisions that we talked about before, where the person who created and funded the IRA during their lifetime, when they take out money out of the IRA, they owe income taxes on it. The goal is to defer the taxes as long as possible. Now the beneficiary inherits it. When they take money out of the IRA, they are also going to owe taxes on it. All right, there's going to be income tax. It's going to show up as a distribution as taxable income on their tax return. There's some exceptions to this rule. We're not going to go to all of them, but here's some major ones. A minor child of the account owner is exempted from this 10-year requirement, but only until the age of majority. So once they become age 18, then they will have to withdraw the full account balance remaining within 10 years. A disabled individual is exempted from this requirement of withdrawing the entire account within 10 years. A chronically ill individual is also exempt. An individual who is no more than 10 years younger than the account owner. So this where that might fit in, maybe someone who didn't have children and left it to a sister or a brother, where this person is no more than 10 years younger. If we think again about the concept, this is really a tax raising initiative by the federal government, because it's going to accelerate all the date by all these, the time by all these taxes are due. And so for an individual who's no more than 10 years younger, they're figuring the life expectancy is similar, maybe a little bit less, a little bit more rather than the contributor. However, it's not going to allow for these long stretches. So let's talk about that. How did it used to work? Well, under the old law, I'm going to give you an example of this 30-year-old beneficiary. And let's say John Client has this IRA valued at $1 million and has a beneficiary, let's call it a daughter, 30 years old. That 30-year-old had a life expectancy of 53.3 years. Under the old law, before the Secure Act, that beneficiary would not be required, although they could have, but not be required to take out money out of the IRA all at once or within 10 years. They would have been able to take this life expectancy and now basically use their life expectancy for the required minimum distribution. Now, remember we said that the taxpayer who contributed the funds, the original taxpayer contributed the funds to the IRA, they have a required minimum distribution. That didn't start until 70.5, now increased to 72 by the Secure Act. But when you were inheriting an IRA, those required minimum distributions started immediately. Okay, and the way we used to calculate it would be the value of the account each year and divide that by the remaining life expectancy, and that would make a much smaller payment than we'll see on the next slide under the current law right now. Now remember, the beneficiary is still going to pay income taxes on that RMD each year, but what it's doing is continuing to defer the payment of the taxes out as far as possible, right? So for many years, right? This person could live for these 53 years. Ultimately, the IRS is only getting slivers of this tax payment each year. But under this new law, okay, the same beneficiary, unless they fit one of the exemptions, so unless they're a minor child, a disabled individual, a chronically ill individual, someone who's more than 10 years younger, they must withdraw the entire balance within 10 years. What this means then is that the RMD becomes much larger. Again, so if you take $1 million policy, divide that by, easily speaking, 53 years versus 10 years, we'll see that the RMD is much larger. And what that means then is that the tax payment is due much sooner, okay? And that's not all. So we'll talk about, on the next slide, an illustration of how these numbers would have played out for this 30-year-old. So basing this off of a $1 million $1 million policy, $1 million IRA at a 7% increase every year, this 30-year-old in the old law, the past method, would have only needed to take out a small amount. I mean, we're looking at here, I'm pulling my laser pointer so we can see here, in year one, $18,762, right? So, and then it goes up a little bit because you'll actually see here in this illustration that the account value is increasing in a way that's outpacing the amount the person's taking out, which is a huge benefit for a client. And we'll talk about some of the things that the client usually is trying to accomplish with planning with an IRA and how this current plan will frustrate that. You'll see now under the 10-year rule, though, you basically have two options. You could take it all out each year. This has some benefits because we'll talk about managing income tax brackets. We don't have a flat tax rate here in either the US for the IRS or even the state. Everything's graduated, which means up to a certain amount, you pay a certain percentage. Once you go over that, the amount over gets taxed at the next bracket. Once you go over that bracket, the amount over that gets taxed. So based off bracket management, it may be more beneficial to take it out in equal installments, but the Law of Secure Act in a vacuum does allow you to take a full deferral and in year 10, take a distribution of $1.9 million, okay? But you look at the difference if we take it in that same equal schedule, in 10 years, instead of a person taking out $18,000 out of the IRA, they're being forced to take out $142,000 plus out of the IRA that year. And now that it's a problem for many different reasons. Well, one, let's put the taxes in the back end of it and talk about what our clients often come to us for. And our clients often come to us to help them with accomplishing not only generational wealth transfer and doing that in a way that's tax efficient, efficient in a way that avoids probate, but they mainly come to us with their concerns that keep them up in the middle of the night. And usually, I'm not sure about you, but the concerns that I hear from my clients are, my son is a physician. If he gets sued, I don't want these funds being subject to his creditors. Maybe I have a son who has spending problems, and if he was to inherit $142,000 every year, he would waste it all. I often hear a concern about the daughter-in-law. Well, what happens if my son or daughter passes away? Who has access to that money? What happens where a child has high income? What happens if that child passes away? Who gets these funds? If we had prepared for this in the old scheme here, these funds could have stayed in the IRA. Again, we're only talking about here about required distributions. Often a client came to us to say, well, let's put these IRAs into a trust benefit. So we can name the trust as the beneficiary of the life of the IRA so that we can force our wishes upon our family, right? Control this money from beyond the grave in a way that will allow for us to accomplish these objectives. And so we would be able to do that in the past. But now we would have to force out this $142,000 to this beneficiary, and that could be a big frustration of their intent. The other piece of it deals with high income. And the idea behind this strategy that we're going to talk about is the idea that there's two things that are certain, right? Death and taxes, right? We know death is coming, and we know taxes are coming, and we can only anticipate, can't guarantee it, but the taxes are going to increase in the future. One, why do I say that? One, I can tell you right now, with the way that the current tax brackets are increased, that was done as part of the Tax Cut Jobs Act. The way it was passed, because they didn't have enough votes to have it be indefinitely, it will sunset automatically in 2025, right? So January 1st, 2026, we will automatically go back to the old tax brackets. And why is that significant? Let's just take a married couple right now that is earning $156,150. They were in the 25% tax bracket. Okay, so they were paying 25% taxes on that money. Anything over that, they would have then went up to the next tax bracket. But that same couple under the current law would be able to earn up to $165,000 and would only be in a 22% tax bracket. And this is talking about the income tax consequences of everything that we're talking about today. The idea being, and we don't have to worry about the details though, is that the income taxes are going to increase in the future. Either if the government gets together and passes a law, I think right now with the unprecedented spending that we're going through right now as part of our economic relief packages that we're having to do in order to jumpstart the economy or even keep it afloat, there's that component of it. But even at a minimum, if no one got their act together and could get the required votes together, this law is automatically going to sunset. And what it means is that the taxes will likely be higher in the future, depending on the numbers. And it's going to be a very, very in-depth analysis to see if it's the right fit for a client. It may be more beneficial for a client to take the tax hit now and at a lower tax rate, at a lower market value, and then pass it off later to accomplish these goals that they wouldn't otherwise be able to do. So what does a solution look like? And so we talked generally about the problem. How do we accomplish the goal of the client to be able to protect assets within the family and pass assets on to the next generation in the most tax efficient way? One solution that we're going to talk about in detail today is using an IRA to purchase life insurance. And what that will do is, for the right client, will increase the after-tax payout to the beneficiaries. And I'll show how that'll happen. They'll be able to protect this asset protection goal that they have. This goal of protecting the failure to launch child, the boomerang child, against the daughter-in-law they may not like or the son-in-law they may not like. Now, this is not the only option, but there are some options we're not going to talk about today in the limited time that we have, but Roth conversions, multi-generational spray trusts, spousal rollovers, using an IRA for our charitable intent that we have, and selectively using the IRA as a charitable piece of our plan rather than use assets that we would otherwise get a step up in basis in. All of those strategies, including the one we're talking today, is why now? The reason why now is because the market value is gone down significantly since last year. We've had some bounce back up, but we're still well down since the beginning of last year. For many people, obviously, each individual holding will take a specific analysis. And also the interest rates right now create a unique environment to get more bang for the buck right now. So have we done this last year versus next year when it rebounds? We might get more now. For example, if we're going to take securities out of an IRA, for example, the Roth IRA conversion here, the same security may have been worth 35% more last year versus now, and we're going to pay more taxes on that appreciation. So let's talk about this particular strategy, though. Overall, the strategy is going to be to create a payment stream from the IRA. Pay income taxes on the distribution now during our client's lifetime. Create and make gifts to an ILIT. An ILIT is an irrevocable life insurance trust. And then the trustee will buy life insurance policy within the ILIT. Just a brief talk about what an ILIT is. The purpose of an ILIT is an irrevocable trust, irrevocable life insurance trust. The goal of the ILIT, essentially separate from this plan, is that if we purchase a life insurance policy within the ILIT, the death benefit will not be included in our taxable estate if it's prepared properly. The goal is that this death benefit, because it's not something we're spending during lifetime, right, is not going to be included. If I had that same policy in my name, that policy will be included in my taxable estate, even though I may have never spent that money or seen a dime of it because I want to pass away. That's when my kids are going to get it. With the ILIT, the goal is to put a life insurance policy in there, have the benefit of that life insurance policy pass outside. We could do a whole talk on just ILITs. Why would the trustee buy the life insurance policy within the ILIT instead of the other way around, creating a policy now, gifting it to the ILIT? It has to do with clawbacks. And so if the account, if our clients, for example, had what they call an instance of ownership, right? So they own the policy and then transfer it to the trust. There's a 3-year clawback that this proceeds, if I passed it within 3 years of that transaction, would be clawed back in. That's just dealing with the estate tax consequences. So let's look at how this John client might look at this. This John client has an IRA, for example, of that $1 million that we talked about, and it's currently earning 3%. This client, again, comes into our office, doesn't want to just say, great, I'm fine with letting the chips land where they may, right? This client doesn't need this $1 million for themselves. They want to be able to protect the money either from a high income earner, a son or daughter who might have already a high income tax bracket because they're making $300,000 a year as a doctor or physician, high liability, maybe that they are their failure to launch child, someone they don't want to have access to money. So they come in, how do we do this now? Because I heard about the Secure Act's going to force them to take it all out, $100,000 a year within 10 years. So the goal here would be then to intentionally start to take some money out of the IRA during our lifetimes and utilize those funds to be able to provide a life insurance that we could continue to hold in trust for as long as we wanted, maybe even into the next generation if that's what your client wanted. But the first step to do that would be to remove some of the volatility that we see in the market. One suggested way that I've prepared, this is not an end-all be-all strategy, but just one that I've prepared for the illustration today, would be to utilize the funds within the IRA to purchase a SPIA, a single premium annuity, for $1 million. Now that would not be a taxable event as long as within the IRA, you did not liquidate the IRA, then purchase the SPIA, but purchase the SPIA within the IRA. And what the annuity contract will do is spin off income every year, guaranteed for life. This will get us a guaranteed payment stream from the IRA that's not dependent on the market value, not dependent on income sources within the policy, within the plan, not dependent on required distributions. And so for this illustration here, a distribution of $50,143. John client will intentionally take the tax hit now, pay the $17,550. Why? Dependent on the numbers. They might be in a lower tax bracket now than we anticipate the tax brackets will be in the future, and will be in a lower tax bracket than we anticipate our beneficiaries to be in, especially when they tack on $100,000 in taxable income on top of their already earned income that they have. Now what? John would create an irrevocable life insurance trust. Again, the goal is that when we purchase this policy, that the proceeds that we are placing in there, that the proceeds of the death benefit of this life insurance policy will not be includable in John's taxable estate. Okay. It'll also give us the benefit of the money that we gift to this trust to be able to maximize our annual gift tax exclusion amount of $15,000, increases almost every year, but right now $15,000. So we create this irrevocable life insurance trust. We have the irrevocable life insurance trustee apply for the life insurance policy on John's life. Okay. Again, we want to have the ILIT apply for the life insurance policy, not John own the policy, then transfer to the ILIT because of the gift and estate tax consequences for the clawback. Okay. Now the net here, well, let's see if we take this $50,000 and we deduct the taxes, we'll have this amount here, $32,000 to gift to the ILIT to be able to pay the premium for the life insurance policy. Now, utilizing crummy letters, again, we could have a whole another segment just on irrevocable life insurance trusts and the mechanisms of them. But if it's done the proper way, utilizing crummy powers and crummy letters with a present right for the beneficiaries of that life insurance policy, the money that we actually gift to this ILIT can qualify for our exclusion. So it depends on the client's family scenario, but if I have 4 people we want to gift money to at $15,000 a clip, that's $60,000 of gift tax exclusion amount that we could use, and we're using some of it. We actually have more. For someone who only wants to gift one child and they're the only beneficiary of the life insurance policy, well, we still have $15,000 of this we can use towards our gift tax exclusion, which means that only the amount over the exclusion then would be taxable. The ILIT then would use these gifts from John to pay the life insurance premiums. And then this policy here would have a tax-free legacy to the heirs. And how does that work? Now, again, it's the difference between the IRA and the life insurance. The IRA is deferred income. It's not, we don't get a step up in basis in this. The day will come due eventually that the IRA, all the proceeds will be taxed. The life insurance will pass, if we've done it the right way and we've done it through this ILIT, outside of the taxable estate for estate tax purposes, the heirs will not have to pay income taxes on it. And this life insurance trust can be prepared in a way that accomplishes the intents of our client to keep it in trust for our beneficiaries at the terms that they see fit, without the IRS forcing the distributions out to that person outright. And that means that they can't commingle the assets and have it be part of a marital division and a divorce. And if they pass away, it won't end up in the spouse's hands. We can take the tax hit right now, be able to preserve and protect the client's assets with their intent through their estate plan. But as you'll see, this is just one illustration. The first thing you'll have to do if you're interested with a client that might have a scenario, we talk to a professional. You'll see we talked about income taxes, ILITs, we talked about life insurance, we talked about estate taxes. We got to talk to a professional who knows the ins and outs of these laws. We talked about many different areas. The other piece is going to be to run the numbers. We got to be able to sit down and run the numbers on what's the estimated tax liability going to be now versus later. And is this actually going to be something we're going to save money on? Or is this something we're going to spend money on? Is it better to accomplish the goals? We got to think about all these things and give the ability for our clients to make an informed decision. Henry is going to talk to you about many different life insurance policies. And I think this is a great point for him to take control here from here, because we just assumed we're just going to purchase a life insurance policy. And I want to hear from Henry today. What he's going to do is talk about the best type of life insurance policy to use for this and many different types of life insurance policies that you have available to you. Henry?
Terrific. As soon as you release the, terrific. Okay. Let me just get started. Really, that was a excellent rendition of what we're talking about. Okay, so again, just thanking the Senior Law Section of the New York State Bar Association for allowing us the opportunity to discuss these important topics. What I'm going to be speaking of, and again, it's just pretty clear that the Secure Act had individuals lose an awful lot of the potential tax benefits that they had by being able to stretch their IRA distributions out over normal life expectancy. Today, they're limited to the 10-year period. It's pretty much accepted that the best way to do that is through life insurance, but the question then becomes what type. And we'll be discussing the various alternatives, some of the good, the bad, and the ugly, and also spending a little bit of time on the subject of life settlements, because there are unfortunately an awful lot of people that are cash-strapped, excuse me, cash-strapped right now, and they could use some of the benefits of their death benefit of life insurance policies today for various reasons, rather than waiting until they hit their beneficiaries. So, different policies provide different options.
Henry?
Life insurance will certainly increase their what's known as COIs, cost of insurance, as a result of the COVID-19 impact on the returns. Keeping in mind, the life insurance companies are really just like banks, and they make the majority of their money, excuse me, on the returns. And needless to say, when returns are reduced down to 0% or 0.25%, it significantly impacts the life insurance returns as we know it today.
Henry?
The point is that all life insurance always has to be actively managed and to be on top of it to be able to maintain. And we'll also talk about some of the best strategies, which again, might be something that some of you may or may not be aware of. There are two different types of life insurances. There's the guaranteed type and there's the non-guaranteed type. Most common type of life insurance available today, approximately 55%, is of a universal nature, and it's basically of a non-guaranteed universal nature. And what happens there is that the premium that the insurance company provides us remains constant. The billed premium remains constant. The death benefit remains constant. The only variable is the duration of how long that coverage actually lasts. And the duration is reduced in time due to the lower rates and the lower earnings of the insurance company. Now, basically, the owner should have increased the premium to make up for those reduced rates, but usually wasn't aware and usually didn't. Again, as I mentioned, roughly 55% of coverage today is of a non-guaranteed universal life insurance. And the insurers benefit when coverage expires early. Next slide, please. This is page 3 of a 6-page annual summary. And if you look down at the bottom where it says important notice, on the bottom of page 3 in small print, it says changes in interest rates may impact the insurance coverage. And basically they're telling us an important notice on the bottom of page 3 in tiny print that basically no one reads. Next print, please. This was a quote from the Wall Street Journal, and basically what it says is that the senior writer for the Wall Street Journal on insurance matters discusses the fact that most people are absolutely unfamiliar with their insurance policies, are unaware that they should be kept well funded, and as a result, many of those life insurance policies are expiring prematurely. Next slide, please. It's not just the individuals or the press that's stating this. This is the Insurance Marketplace Standard Association, and this is a fellow named Donald Walters, who is general counsel for the life insurance industry. They're saying that while insurers have not publicized the issue, there is certainly a growing concern in the industry about lapsing universal life policies. Next slide, please. Now, on the other end of the spectrum is something called a guaranteed universal life policies. Guaranteed policies, the premium is sufficient. It's set at the time that the individual purchases the policy. And it's also the least expensive way to purchase permanent coverage. It doesn't provide any accumulation. So at the end of 5 or 10 or 15 years, there will not be any accumulated money to be able to take out, but you will provide maximum coverage, and that maximum coverage is guaranteed. The guaranteed policy is not affected by the pandemic, and it is suitable for the stretch IRAs or offset planning. Next is something that's known as the indexed universal policy. That is based on a specific return on a sector in the stock market. Now, what they do is they will set a limit on how much of the return. In other words, if there's a 15% return, they might set a limit that you can only achieve the first 5% or 6% or 7% on that total return. Now, you have that in exchange for a floor on losses. The returns for anyone who had a indexed universal policy was not affected by this stock decline that we've recently experienced, but the fees will continue to be deducted. And when there are negative years, as there probably will be this year, while there are no losses in the actual stock market, in the actual returns, those fees will continue to be deducted, and those fees will eat up the death benefit, and that death benefit is not guaranteed. As a result, this is affected by the pandemic and is not the right type of a policy for an individual looking for a premium offset. The next type of policy is something that's known as a variable life insurance policy. There, the coverage is based 100% on the stock market returns. There are no guarantees. So if an individual purchases a variable policy because he or she is promised the fact that there will be a tremendous V-shaped recovery, and that V-shaped recovery turns into a W-shaped recovery or a U-shaped recovery, or anything where the market goes back down, there are no guarantees, and the coverage can increase or decrease. Again, any type of future decrease on that marketplace will affect the duration of that coverage. Again, this is a policy that's affected by the pandemic and not suitable for any sort of Secure Act offset planning. One of the original types of policies was a whole life policy. A whole life policy is guaranteed for the balance of the insured's life. The policy accumulates cash value, and usually by the time an individual is in their 80s or 90s, the individual is being paid back with pretty much their own money. It provides the least amount of death benefit and is also the most costly type of coverage. Although the facts are what they are, the duration of coverage is not affected by the pandemic, and it is suitable for Secure Act offset planning. However, I would not recommend this simply because you're paying the most money for the least amount of coverage. And when your beneficiaries eventually receive the money, depending on date of death, they're going to be paid back with a significant amount of their own money through the accumulated cash value. One of the most prevalent, and as far as I'm concerned, one of the best ways to purchase a life insurance policy. And again, let me just take a second just to say that an individual can purchase a policy that pays when an individual dies, or an individual can consider purchasing what's known as a second to die policy, which won't pay out the death benefit till the death of the second individual. And if you think about it, for the inherited IRA, this is exactly when the money needs to be available to be able to offset the next generation's future tax liability. This type of strategy is available with all types of policy, with the exception of term insurance. The cost is significantly less with a second to die policy. For example, cost of a $500,000 guaranteed policy for an individual to age 70 to age 96. Use an example of a male age 78. The individual cost of $500,000 would be $31,700. Assuming his or her wife is age 74, that same cost for that $500,000 guaranteed death benefit to age 96 is approximately $18,000. However, a second to die policy, the cost for both would be approximately $14,700, significantly less than paying for the insurance for that individual age 78 or even for his wife. Two types of insurances which were the old favorites: whole life insurance and term life insurance. Term life insurance is the least expensive cost for a maximum death benefit. It does not accumulate any cash value, and it can be guaranteed for 1, 5, 10, 15, 25, or even 30 years. But all term insurance ends between age 80 and 82. Keep in mind, only 2% of term insurance policies are ever paid out. As a result, this is not suitable for the Secure Act offset planning, although it appears to be the least expensive way to purchase life insurance. But the life insurance has to be available for the individual and has to be there after the individual passes away, rather than the term insurance expiring before the individual passes away, as does happen with basic term insurance. Now, I think the example that Jay gave with annuities is one of the best ways of using the accumulated money in a IRA, even better yet, in a IRA Roth conversion, as Jay explained, because of the current decline in the stock market. This will provide less in the way of taxes being paid initially and more in the way of money available to be able to be used to buy a death benefit. Now, annuities, you should be aware that the Secure Act now allows annuities to be used in qualified plans. Heretofore, that was not the case. Now, annuities can accumulate tax deferred annuities. And let me just mention that there are two types of an annuity. One is the single premium immediate annuity, which is the example that Jay provided. And then there's also something called a single premium deferred annuity, a good way to accumulate funds on a guaranteed basis. And again, in terms of where and what the stock market has done, somebody looking at a 3 to 5% guaranteed return based on how long they want that guarantee to last for is not a bad alternative to be able to be considered for diversifying clients' portfolio. Again, annuities can also be used to pay for long-term care costs. And again, just that single premium immediate annuity is an ideal way to pay for an individual's insurance premium on an ongoing basis to guarantee that both the premium as well as the death benefit will be there whenever the individual passes away. For those of us that are calling in on telephone rather than viewing the actual presentation, the MCLE verification code is letter R. Again, the MCLE verification code for those of us on the telephone is the letter R. Now, if there's a problem with an individual's policy, there are basically 4 options. The individual can either reduce the death benefit, the individual can pay a higher premium, or if the individual is healthy enough, he or she can obtain perhaps a new guaranteed contract if in fact they are able to based on health. The 4th option is something called a life settlement, and the 5th option is a combination of the above. If life insurance is either no longer affordable due to the pandemic, or if people need the cash immediately to pay for other costs, or if life insurance is deemed to no longer be needed to pay for these state taxes, again, as Jay explained, the sunset provision kicks in 2025, and the tax exclusion goes from an $11 million per individual back down to approximately a $5 million estate tax exclusion. So many people, for whatever reasons, may feel that, well, let me just go ahead and get rid of some of my taxes, some of my life insurance. And many people will use two options to reduce or liquidate their current existing life insurance policies. They will either go back to the insurance company and surrender the policy for its cash value back to the insurance company, or they'll just use up whatever cash value is there and let the policy just continue paying for itself, and eventually that cash value will run out, and eventually that policy will lapse. The life insurance option provides a significantly larger return. For example, a male age 82 with a $3.5 million death benefit with $1.2 million in cash value, if that individual decides to forego his $3.5 million life insurance policy, he can go back to the insurance company and receive $1.2 million in cash value, or he or she can go to the secondary market through a licensed life insurance settlement broker and receive $1,875,000. This was a previous case that I just concluded. So these are real numbers. Unfortunately, many advisors and the majority of clients are unfamiliar with this. And the reason that they're unfamiliar with this is due to a case called Larry Grill versus Lincoln National. It's a situation where the insurance industry basically has placed a gag order on the individual agents because the insurance companies, as I explained earlier, like when policies expire. And the gag order basically said that the insurance agent nor the insurance company did not have a duty to disclose this option. I'll talk more about that in a moment when we get to the current regulations that were just passed regarding the duty to disclose. Next slide, please. The requirements for life settlement: individuals should be at least age 70. The minimum death benefit is approximately $100,000. The individual should have some medical issues, and all types of policies, including a term policy, can qualify for life settlement. And again, I think the most important aspect there is to select an independent life settlement broker to be able to go into the secondary market for you. Next slide, please. Very quickly, I know that there was recently a program on the subject of business interruption insurance, and just for those that might not have been on that call, many people who were significantly affected by the existing pandemic with businesses closed, many of those people had a business interruption insurance policies. Unfortunately, they did not find out until after they went to collect that all of those business interruption policies exclude a virus pandemic. And this occurred as a result of the SARS virus in 2008, where insurance industry just realized that it could not afford to pay the costs for business interruption in the result of a worldwide pandemic. More on that as individual attorneys are putting together all sorts of class actions and hoping that the government will intercede and help the insurance industry come up with a way to pay for that business interruption insurance. Next slide, please. Again, embarrassed to say that it wasn't until February of 2020 that the insurance industry first regulated through Regulation 187 that an individual agent has the duty to inform his or her clients. Although there is no obligation for providing post-sale services, in other words, the obligation is still up to the individual to maintain and to actively manage their policy. It is not the obligation of the insurance company nor of the agent. It's the obligation of the owner of that policy or the trustee. Individual does not have to provide the least expensive product to the individual, but the new rule does require full written disclosure of the risks and full disclosure of compensation of the agent or broker providing the transaction. Many of these items that I've mentioned today regarding the idea of life insurance not living on forever and life insurance expiring before the individual that it's insuring are covered in this American Bar Association book, which I co-authored back in 2018. Next slide, please. For purposes of time, I'm going to slip by this, but if anyone is interested, if people download our handouts, and if anyone requests this information, I'll be more than happy to send that to you or include that. Basically, we just are running out of time, and I want to leave some time for the open-ended questions. So again, thank you for your participation, and please submit your MCLE verification forms back to the email that was mailed from. I'm going to open it up for any questions for either Jay or myself.
We do have one question right now that says, Jay, at this point in time, is it no longer advisable for the owner of $1 million traditional IRA with only one child who is under the age of 10, for example, to make their revocable trust the beneficiary of the IRA?
That's a great question. And before I answer it, let me just mention also, I didn't mention at the end of my slides, but if we don't get to any questions, my email address is included in the materials. Feel free to call or email, and we'll be able to discuss that. So that's a really good question. It's going to depend on the client. I mean, you have to have a client-specific conversation about their wishes. You're also going to have to take a look at the underlying costs associated with the trust. Let me just talk about some things you could think about. Through the revocable trust, the common way to do it before the Secure Act was to include a trust for a minor in there. They either set it up as an accumulation trust or as a conduit trust. And they were called collectively see-through trusts that would allow you to have the trust hold the proceeds of the life insurance policy and only pay out the distributions that needed to be done. Through the accumulation trust, the trustee would have had the ability to accumulate the trust income, so the trust distributions, so that way, with their discretion, didn't have to distribute it outright to the beneficiary. Through the conduit trust, instead, that they would have to force out those distributions to that beneficiary. So you could still set it up that way through a revocable trust. The problem with the conduit trust, though, and through a revocable trust plan would be, one, that it's going to force out those distributions to that beneficiary within the 10 years, which is not going to take care of any of the tax consequences that we talked about. It's also not going to take care of any of the asset protection questions that we had. Before, under the old law, I could have just taken the life expectancy amount, which might have been a very slim piece of the IRA, and allowed the balance of the IRA to sit in that trust. So if instead now we go with the accumulation trust to be able to accomplish that protection, and we're saying we don't want to allow this either minor or even a young child, it might be 18, 19, 20, to have access to that kind of money, we need to hold it in accumulation trust. And this is where the analysis will come in. If we hold it in an accumulation trust, the RMDs that had to be taken out every year out of that accumulation trust that are now held by the trustee are going to be taxed at the trust tax brackets, which hit a top tax bracket of 37% at just $12,750 of income. And so that is a significant amount of money. So it comes from an analysis of thinking, well, if that's the goal, maybe that tool may have worked in the past, but now let's take a look and say, well, with the decreased tax brackets, maybe we take it out now and utilize a strategy like this, where it doesn't necessarily have to be this ILIT that we talked about, but to get money out of the IRA now and have the ability to control it later on, longer into that child's lifetime, without the negative tax consequences. And it's going to come down to a fact specific, run the numbers. Like I said, run the numbers, see what's that 37% going to be down in the future. And if that even goes up in the future, who knows? So that'll come from a really specific conversation with the client. And I should note that with this child who's under age 10, they wouldn't have to start those distributions under the Secure Act until they hit the age of majority, and then they'd be forced to take it out. So now we have, within those 10 years following hitting age 18. So now we have an 18-year-old getting $100,000 in that $1 million example from an IRA, which I don't know if that's what your clients may want.
Jay, I have a question. We've all done and seen many webinars discussing the Secure Act or discussing the opportunity for Roth conversions. Have you seen an uptick in clients in general, prospective clients in general, being aware of these of the new law and of the new opportunities available?
So I haven't really seen clients necessarily being aware of it. What I have been seeing is getting the word out to advisors. I think right now everybody's kind of in this stick the head in the sand kind of mentality right now, especially as the beginning of this crisis started. Where, I mean, even I'm sure many of you saw many of our consults just dropped right off. And then people started to tick back up. I think you're starting to see that awareness now. I've been focused on getting the word out to the advisors, saying, hey, this is a great opportunity to be proactive with the clients. Now, it's not for every client. We all have clients that will continuously want to stick their head in the sand, and that's fine. And it's not our job to force them into anything. But to the person who wants to think strategically and take advantage of an otherwise poor situation, and I guess make lemonade out of lemons, right? That would be something to get out to advisors to let them know. Because they're often in the best position to speak to their clients about that. Where often people come to us either through the advisor or when something catastrophic has happened.
Yeah, I guess the timing on this was the absolute worst time, where people, instead of being able to concentrate on the problem and on some of the advanced planning solutions, instead everyone's thinking about, how do I stay healthy, or how do I stay safe?
Which which should be first and foremost. And then if everybody's happy and healthy, we can look at some of these things. And these options don't go away after this crisis is over. A lot of this has to deal with the Secure Act, which just happened to be so new right before this all happened, that it'll still be there. These planning opportunities will be there. And Henry, I had a question for you. Often I sit with a client, and I like preparing trusts and doing plans and thinking about options to help a client. But you know what I hate looking at is the plan summaries when they come in with their life insurance quotes. What are the things that we should look at, like the top 5 things we should look at that plan summary sheet, to make sure that what they got from an advisor fits into the plan that we're helping them with?
Well, and that's a great question. The first point to keep in mind is that the plan summaries do not come from the advisor. The insurance company sends those out once a year. They're usually 5-6 pages long, and the most important piece of information on those plan summaries is there are 2 ways of looking at it. One is on a guaranteed basis, how long will the policy last? And the secondly is on a current assumption basis, how long will that policy last? So the most important thing that I'm concerned about is, on a guaranteed basis, how much longer in duration will that policy remain in force for? In other words, if the individuals continue to pay the premium on a guaranteed basis, how long will that policy remain in force? Keeping in mind, on a non-guaranteed policy, the insurance company has the right, contractual right. They don't have to get any authorization from the insured or from the state. They can just go ahead and increase what I mentioned earlier, the COIs, the cost of insurance. And they have done that in the past, and they will certainly continue to do it now as a result of the pandemic. And those increased COIs can slash the duration of an insurance policy. I've seen it by as many as 5, 6, 7, and plus years. And that's really a dangerous thing. People see what they want to see. They see the current assumption is based on, will last until an individual is age 90. But the guaranteed assumption, but the guaranteed number might last until age 82. That could be a 8-year difference. And that's based on facts that we have today. Insurance companies haven't yet begun to increase their COIs, and I'm certain that in non-guaranteed policies that they will. So that's the most important piece of information that I look at in a plan summary. Now, what an agent might provide a client is a illustration. And those illustrations on anything other than a guaranteed policy are nothing more than assumptions. And, an assumption is really nothing more than assume with a couple of extra letters. And you know what they say about anybody who assumes anything? Well, unfortunately, the life insurance industry allows individual agents, and I've seen assumptions going as high as 8.5% assumed each and every year, which are, as far as I'm concerned, unrealistic numbers. So that's an important piece of information that I look at. But today, life insurance policies should not be looked at, in my opinion, as investment pieces. They should be looked at as secure, guaranteed, providing death benefit to the individual insured, and to his family, rather.
Thank you.
All
Well, I
right.
think we've run over our time, so Dana, back to you.
Thank you again, both to Henry and Jay.